Pfizer just dropped its Q3 2025 earnings, and it's a classic tale of two stories. On one hand, they beat expectations and raised their profit outlook. On the other, the stock dipped. So what's really going on? In this video, we'll break down the key numbers, what management said, and what it all means for investors. Stick around to the end for our key takeaway. Pfizer Inc., ticker PFE, is a premier, research-based global biopharmaceutical company headquartered in New York City, with a long-standing mission to discover, develop, and deliver breakthrough medicines and vaccines that significantly improve patients' lives. Founded in 1849, the company has grown into one of the world's largest and most influential pharmaceutical corporations, boasting a diverse portfolio that includes treatments in areas such as oncology, immunology, cardiology, and neurology. Pfizer achieved global prominence, particularly in the early 21st century, through its development and distribution of one of the leading COVID-19 vaccines and an antiviral treatment in collaboration with BioNT. Its business model is driven by innovative science, strategic acquisitions, and collaborations, aiming to address unmet medical needs and generate strong financial performance for its shareholders. Let's start with the headline numbers. For the third quarter of 2025, Pfizer reported revenue of $17.7 billion. Now, that was actually better than analysts were forecasting, but it represents a 7% decline compared to last year. The main culprits? The continued expected decline in sales of their COVID products, Paxlovid and Comirnaty. Where things get interesting is on the profit side. Pfizer's adjusted earnings per share came in at 87 cents. That's a solid beat over the consensus estimate, which was hovering around 65 cents. This is the number that really caught Wall Street's attention and is the core of our good news story. And this strength led management to do something investors always love. They raised their full-year profit guidance. They're now forecasting an adjusted earnings per share of $3 to $3.15, up from the previous range. This signals a lot of confidence in their cost-cutting measures and operational discipline. It's worth noting they reaffirmed their full-year revenue guidance, showing they saw this quarter's performance coming. So, if revenue is down, where's the strength coming from? Let's look under the hood. First, non-COVID growth. When you strip out the pandemic products, Pfizer's business actually grew by 4%. Key drugs like the blood thinner Eliquis, which was up 22%, and new blockbusters like the migraine drug Nurtec and the rare disease treatment Vyndaqel are picking up the slack. Second, shareholder returns. Pfizer is putting its money where its mouth is, returning a massive $7.3 billion to shareholders so far this year through dividends. And third, strategic moves. Management is aggressively investing in the future. They highlighted the planned acquisition of Metsera, a key move to get a piece of the booming obesity drug market. Now, what did the top brass have to say? CEO Albert Bourla expressed optimism, highlighting a renewed confidence in delivering value. But perhaps the most telling comments came from CFO Dave Denton, who emphasized that this quarter's outperformance was rooted in strict cost management and a relentless focus on shareholder value. All right, so with all this good news, an earnings beat, and raised guidance, why did the stock dip in pre-market trading? It comes down to the bigger picture. Investors are weighing the strong cost control against the reality of a post-COVID world. The decline in high-margin COVID sales is a real headwind. There was also a one-time charge of $1.35 billion this quarter related to a licensing deal, which dinged earnings. So, the market is trying to answer one question. Can Pfizer's new products and cost cuts grow fast enough to not just offset, but surpass the COVID cliff? That's the billion-dollar dilemma. Let's talk about the bull case, the reasons for optimism. First and foremost, valuation. Many analysts argue that Pfizer is currently undervalued. Advanced financial models like discounted cash flow analysis suggest the stock has significant upside potential if its new long-term strategies pay off. Second, financial discipline. Pfizer has actually raised its full-year earnings guidance, thanks to strong cost-cutting and operational efficiencies. This financial health supports what is arguably its biggest attraction, a robust dividend. Pfizer isn't just a dividend payer, it's a dividend grower, with a 16-year track record of increasing payouts to shareholders. And third, the future pipeline. The post-COVID era for Pfizer is all about its new drugs. The company is aggressively building a diversified portfolio in high-growth areas like oncology, rare diseases, and migraine treatments. A key area to watch is obesity drugs, where Pfizer is even in a bidding war to acquire a company called Metsera. This pipeline is the core foundation for its medium to long-term growth story. So, the bull case is strong: an undervalued stock, a reliable dividend, and a promising pipeline. But now we have to address the bear case, the significant risks that are keeping some investors on the sidelines. The biggest challenge is the revenue cliff. Pfizer is facing patent expirations on massive blockbuster drugs like Eliquis and Ibrance. When patents expire, generic competition swoops in, dramatically cutting sales and revenue. This is a huge hole to fill. Compounding this is the continued shrinkage of the COVID-19 product franchise. While this was a windfall, it's now a fading tailwind, creating persistent revenue headwinds. There's also a debate about its financial strategy. Some analysts warn that cost-cutting can only go so far. You can't just cut your way to growth. If the top-line revenue continues to stagnate or decline, even those improved earnings and the beloved dividend could be at risk down the line. Finally, there's strategic uncertainty. That bidding war for Metsera in the obesity space? It's a perfect example of the intense competition Pfizer faces, in this case from giants like Novo Nordisk. Winning or losing these battles adds a layer of volatility to its future growth plans. This all leads to cautious market sentiment. Analyst ratings are mixed, and the stock has been known to see significant volatility, especially around quarterly earnings reports. For the income-focused, long-term investor, Pfizer presents a compelling case. You're getting a strong, reliable dividend while you wait for the company's massive R&D investments and pipeline to hopefully bear fruit. You're being paid to be patient. The current annual dividend is $1.72 per share, paid out quarterly. With the stock price where it is, that translates to a massive dividend yield of around 7%. So on the surface, Pfizer looks like an income investor's dream, a high yield from a company with a rock-solid history. But to understand the full picture, we need to look under the hood at its financial health. This is where we encounter the biggest cause for concern: the dividend payout ratio. Simply put, the payout ratio is the percentage of a company's earnings that are paid out as dividends. A ratio of 40 to 60% is generally considered safe and sustainable. It leaves plenty of room for reinvestment in bad years. Pfizer's payout ratio? It's sitting at a staggering 99.4%. Let that sink in. For every dollar Pfizer earns, almost all of it is being paid out to shareholders as a dividend. This leaves very little cushion. If the company's earnings were to decline unexpectedly, the dividend would immediately be at risk because there's no safety net. It's a sign that the dividend is being prioritized over reinvesting heavily in the business for future growth. So, with this massive red flag, is the dividend safe? The consensus among analysts seems to be safe for now, but risky in the long term. Here's the balancing act. The support. The dividend is currently supported by Pfizer's still robust free cash flow. The company is still generating enough cash to cover the payments. Furthermore, management has actually raised its earnings guidance for 2025, which shows confidence in the near-term outlook and supports the idea that the dividend is secure for the next year or two. The risks. The long-term threats are very real. Pfizer is facing a well-documented patent cliff where key drugs like Ibrance and Eliquis will lose their patent protection, opening the door to cheaper generics and causing significant revenue declines. There's also intense competition in its core product lines. If the company's pipeline of new drugs doesn't successfully replace this lost revenue, earnings will fall, and that 99% payout ratio will become unsustainable. Pfizer's 7% dividend yield is attractive and historically reliable, supported by strong cash flow for the immediate future. It is likely safe for now. However, it is not a set-it-and-forget-it income stock. The extremely high payout ratio and looming revenue challenges mean this dividend requires active monitoring. Let's get straight to the consensus. The overarching sentiment from analysts covering Pfizer can be summed up in one word: hold. Out of 18 Wall Street analysts, 11 recommend hold. 4 say buy. 2 say strong buy, and just 1 recommends sell. So the message is clear. If you already own it, sit tight. If you're thinking of buying, the majority advise caution and patience. But what about price? The average 12-month price target sits around $28.13. That implies a potential upside of 13 to 16% from current levels. And the most bullish analysts, who are betting on Pfizer's pipeline and strategic moves, see it going as high as $33.